Mistake number one, by far, in my opinion, people have way too much money allocated to trading. They're treating the stock market as a trading account. Mistake number one, by far the biggest one, and it leads to all the other problems I said. Point number two, emotions. That leads to not hitting stop losses, and not letting trades come to them. And there's a lot of people that are in the markets and have been in the markets. Some people are brand new. Diversification is the only way to ultimately grow money at a steadier level. Because if you have a drawdown of 20% or 10% as opposed to a drawdown of 40 or 50%, which again is very normal for a lot of people, particularly hold equities, that makes a huge difference over time.
All right. Hey, everybody. Happy July. We did it. First half of the year's over. We're in the second half, and things are changing underneath the surface, slowly but surely. So we're going to give you a bit of an update here today as to what's going on. And, a lot of people are seeing a lot of gains in their tech stocks. And I think there's a bunch of different ways to hold on to those gains, even if the market were to go down. So we're going to go through a few things for you guys here today that I think will be well worth your time. Now, before we get started, I want to make sure that you guys can hear me okay and you can see the screen. We're going to wait another minute or so before we get started, and I'm going to just quickly bring up the chat and the questions box here. We'll just give it another minute or so, and then we'll get going. So if you guys could just put a quick yes in the I guess it's the quest. It might be the webinar chat box. I'm not even sure.
I'd say, Serge, I'm here with you. I would say, hey guys, it's Jeanette. I would say just use the question and answer box because then you can see all of it in one place.
Okay.
You can Serge, and you don't have to dig around when people are asking you stuff.
Yeah, that sounds
So
good.
guys, why don't y'all find the questions, the Q&A box, and just try to use it, and that'll help Serge out, I think. There we
Perfect.
go. All right, they're using it now, and they're saying they can hear. Awesome. Did you
Yeah.
find it, Serge?
Yeah, yeah. I got it. I got it. All good. Thank
Oh
you.
yeah. Okay.
Cool. Very good. Let's see. All right, everyone can hear us. There's a lot of people coming in here right now, and you know what? It's obviously we're here in July. We've got the 4th of July holiday coming up, so um, a lot of people are going to be opening up their account statements for the first half of the year in the coming weeks, and they will probably see some gains if they have U.S. equities. The S&P 500 had another fabulous first half of the year, and while that can continue, it's just maybe a good idea to be prepared for what if it doesn't. There's ways to look at this through a different lens as well. So we're gonna look at this here together in just a second. Just want to again just give people maybe one more minute, and then we're gonna get started here. Just make sure everyone can log in here on time. All right. All right, cool. Let's get started. So as you can see, what the topic is today, it's essentially about the different parts of the market that are performing at different sort of speeds. And what we do is we rotate through the market through the lens of sort of a sector and group rotation strategy, which not only allows us to be in things that are working and hopefully as much as possible not be in things that are not working, but also it allows us to not have our eggs all in one basket, right? And yet can let our winners continue to run. So there's sort of multiple layers of benefits to that type of approach. I want to share with you guys a little bit as to my why I'm doing this, but I'd love to hear from you guys. What is your reason for being in the markets? Everyone's got a reason for doing certain things. Maybe your reason is something like, I don't know, financial freedom or traveling or whatever. So let me know what your reason for your why is. Why are you in the markets? Why are you trading? Why are you investing? For me, this is your truly here, Father Trader Portfolio Manager. I was very fortunate to be introduced to this business now about 26 years ago, or maybe even a bit more. And I continue to do it because I love doing it for my family, and it's allowed me to be able to travel and work in different places around the world, and really just enjoy that. So looks like some people are chiming in here. Yeah, I mean, as I thought, a lot of people are saying it's a way to make some additional income, make a living. Someone said for the grandkids, freedom. Yeah. So that's typically kind of what people do it for, but you never know. Some people have different reasons. Ron is saying to maintain a standard of living. Exactly. So I think those are all, I mean, any reason's good, right? But those are sort of the common and certainly well thought out reasons. Before we get started, just quickly, risk disclaimer, and you guys know this, right? Trading and investing does carry a lot of risks, but I need to reiterate it. And, it's not linear. I think being in the markets is a very serious business because we're talking about, putting real money at risk. And so, I would always encourage people to get as much educated as you can on this, which of course is what these sessions are all about. We're not giving you any investment advice here, so please keep that in mind. But it is important that this is being looked at as a serious business and not entertainment. So please do to take this serious. So we're going to move pretty quickly today. We don't have that much time together, but specifically my goal is to get you from someone who might be a bit unsure about their process to being much more clear about what a process would look like. Specifically for me, I know we're mid-year now, as I mentioned before, but I'm looking to beat the S&P 500 3-1 over the next 12 months. So I always like to look out 12 months. So far, we've done very well. I'm going to show you guys this here in just a second. But that's my goal here, and hopefully we can continue to do so with a rotational approach to the market. So, for example, by rotating through the market, and specifically, we like to use ETFs to rotate through the market, not because individual stocks are crap, but there's certain reasons for that, which I will cover specifically. And I'd love for you guys to take some notes on that when I go through that. Maybe you can use your phone and take some pictures of it. That might be even easier. But for example, in 2025, we had our sector and group rotation strategy. And again, we use exclusively ETFs for that. So these numbers are not based on leverage. If one would have used options on this, the performance would have been multiples of 230%, right? But 230% of cumulative closed trades, right? So adding all the gains up of those closed sector and group rotation trades resulted in 230% of gains in that portfolio. And these things are all shared in real time with our clients. Now, some of you guys are saying, that's nice, Serge. Talk about last year. What about this year? So this year, oh, and by the way, last year, the way that compared to the S&P 500 is something like this. The S&P was up again last year nicely, actually, I think 18%. But again, obviously 230% is mathematically and optically at a different level. This year, we are so far up. I was just looking at it again before, 73%. In fact, I can show you this, where these numbers are from. This here is the spreadsheet, so you can see 73%, 73.3% to be specific. And if you put that into a chart, which is what I did here, you can see at the bottom you have the time, or these are positions, and then the percentage is the y-axis, the horizontal axis. So you can see, again, 73%. We were up as much as 80-something%. Now we're up 73%, and coming back nicely. So that's year to date on those metrics. What's going on here, though? Well, what's going on underneath the surface is a market that's very much rotating, right? We continue to see different stocks work higher at different paces. Money goes into one part of the market, then moves out of another part of the market, and it's a constant ebb and flow. And if we can capture some of those moves, we can not only is it a less stressful way of being in the markets, because we're looking at specific pockets of stocks, sectors, groups, other asset classes. It can be done with ETFs. But also, it's actually a better way to not get stuck with just one idea and just have a massive concentration risk of one idea in the portfolio that could blow everything up. That's another great reason to do something like this. And you can see these squiggly lines here. These are, for example, the S&P 500 sector ETFs that break down the sector of the S&P. It's about 11 of them, actually. And so we can rotate through those. For example, there's way more we can rotate through, but that's just some of them. Give you sort of a simple idea on that. I'm going to give you a quick market update here in just a second. And then we're going to look at a key role of why we use ETFs and specifically talk about the strategy so that you can maybe implement this one as well. And I'll give you specifically two specific ideas of things that we have recently rotated into, have taken some profits and think could be a massive opportunity, possibly for the rest of the year. So we'll go through all that here as well. Okay. So the S&P 500 is, in our view, going to probably return maybe 5% per annum over the next number of years. If you look back at the past number of years, 15 years or so, the S&P's made closer to 15+% per year. That's historically a massive anomaly, and it's probably not going to continue much longer. And so what has happened is investors and traders have kind of gotten used to these massive returns, these double-digit returns of the S&P, kind of forgetting that we from time to time go into these like 5 to 10 year lull periods, which is likely knocking at the door here again right now. And I think 2025 was actually the beginning of that, even though we still had a good year. And so far, the S&P here at the midpoint of 2026 is doing well again. However, if you look at this through the lens of maybe not betting the farm on just one thing, something becomes very glaringly obvious. And so this is, for example, comparing the S&P 500 over the past 20 years. So that's the blue line at the top versus the Dow in purple versus the small caps which are in red, and you can see how dramatically the S&P's outperformed those. Others won, and it's because of this. So the XLK represents the S&P 500 tech sector, which represents basically our multi-trillion-dollar market cap friends like the Googles and the Microsofts and the names that you all know, the NVIDIAs. And a lot of people want to hold on to those stocks. They want to continue riding those waves, and we certainly think that makes sense. It's not advice, but it makes conceptual sense. And there's ways of doing that, right? And continue riding that wave without having to sell those stocks. And one way is by rotating through sectors and kind of, putting our eggs not just in one basket, but in a few of them as well, and in sort of the fastest horses as much as possible. The S&P 500 itself, though, is at a pretty critical spot if we look at this not just through like a multi-day, multi-week lens, but really through a a decade lens. In fact, this chart here, it takes us all the way back to the early 1900s, and you can see that over that period, we've basically been able to see the S&P grind higher in a very specific channel. This is just an optic. And we're certainly at the upper end of that. And this is just the price chart. But from a valuation perspective, we're at a very similar spot. Now, this can continue, right? And this is why, it's not something where we have to say, okay, we have to go sell or dump all our NVIDIA stocks and, stop riding that trend, assuming it continues, and take massive, pay a lot of taxes on it, which I know a lot of people don't like to do. But it is just to point out where we're at. And if you take this a step further, you will notice that if you go all the way back to the early 1900s as well, we, for the most part, outside of the Great Depression and World War II and all that period, we've largely sort of had these 14, 15-year cycles where the S&P would go up for 14 years, sometimes a bit more, and then basically go sideways for 14 years. And we believe we've reached one of those spots again right now. We're pretty close to it. I don't know when exactly that starts, but we would argue if we're not there already, we're very, very close. And so the question, of course, is how do we mitigate that, especially in a market where everything is basically concentrated on a few mega cap tech stocks, which, by the way, is not abnormal. A lot of people are kind of poo-pooing this and saying, oh, it's very risky. This happens all the time. And when you have a market that's very heavily concentrated, it just means that there's a new revolution of some sort happening, right? Whether it was the dot-com bubble or the energy bubble or whatever we had over the years, and of course now we have the AI thing. That's a pretty normal behavior. It's just that when it ends, it can kind of rip apart portfolios and people's net worth, and so we want to make sure we are kind of taking that into consideration. This is just how large some of these 10 largest S&P 500 firms are in terms of the market cap, almost 40, I think. I don't even know if it's a bit more or less right now, 40% of the S&P 500. And so, which introduces the idea of a sector and group rotation strategy. And so what we do with a strategy like this is we exclusively use ETFs for that. I'm going to give you guys some of our favorite ideas in just a little bit. But whether we look at it from a cyclical perspective, whether we're cycling through different parts of the market based on where the economy's at, early cycle, late cycle, expansion, contraction, or we look at it just from a momentum perspective, right? Both work, and both are probably in our approach. It's both part of the strategy. But the beautiful thing about a rotational strategy, particularly using ETFs, is that we don't have to be too concerned about having massive concentration risk in just one type of asset, right? One type of idea, one type of tech stocks, for example. And we are very much in a rotational market right now. I mean, I can show you guys. We actually rank and track every ETF there is out there. And I can show you guys right now, actually, just for a minute, for example, where the S&P 500 ranks right now in terms of whether it's long-term bullish or short-term bullish, and kind of what that looks like. So, for example, if I look at this, and you guys can have access to this ranker as well afterwards, for those of you guys who would like to. So let's just take the NASDAQ 100. So this is the QQQ ETF. And you can see that has been bullish for 85 days. So 85 days ago, which is, I don't know, yeah, somewhere around here, it turned into a longer term bullish trend. So basically that was a buy signal, right? And it's been kind of neutral for a few days. And 3 days ago, and we get alerted on this in real time, and as do our clients, you can see 3 days ago, it went back into a new short-term bullish trend. And the next price target is $765 on the QQQ ETF. I could do the same math, and I could pull up the S&P 500 here as well, and it would tell me as well what's going on here for it. So for example, the S&P actually turned bearish 8 days ago. So somewhere up here, and remains bearish right now in the very short term, but it does remain bullish the longer term. And you can see it to 85 days ago, somewhere around here, turn into a new bullish trend. We can look at any ETF to see where it is in terms of the trend and the momentum, short term and longer term. In fact, we can even look at the individual components and see what they are. For example, and I should probably pull up the NASDAQ 100 for this, be a bit better. And we can look at other ETFs as well. So if you guys have any ETFs you want to look at, tell us and we'll look at it. For some reason, they're not pulling up right now, but they're going to pull up, and you're going to see every single holding of these different ETFs. Okay. Anyway, so that's what's going on right now. The S&P 500 is very, very short term, a bit bearish, long term bullish, and the NASDAQ 100 is now both bullish in the longer term and even the shorter term again as well. Okay. So that's where we are on that. Now, one of the questions that we always get, and I'd like to make this very clear, the role of ETFs in this strategy as opposed to individual stocks, there's very specific reasons why we like to use individual ETFs rather than individual stocks. And a lot of it has to do with not having to think about something called idiosyncratic risks. We'll get to that a bit more afterwards. But we think that right now, as we've entered a very late stage bull market and a more rotational market, if the S&P 500 were to rotate and basically again give us sort of that 2 to 5% per annum return, it won't be enough for most people who've gotten used to sort of these 10 to 15+% years over the past decade and a half, quite frankly. So we believe that investors that allocate to the outperforming parts of the market are going to be in a better position to achieve better results closer to what we've had over the past decade or so. Okay, so that's really one of the main points here of what we're trying to make. New market leadership emerges all the time, right? Past winners fade. I'm going to show you guys, for example, what's happened so far this year already, and new areas of markets, of pockets of opportunity arise. So like, for example, we've had a big rotation into energy stocks and industrial stocks, and more recently into healthcare stocks, earlier this year into commodities, at the expense of a whole bunch of different parts of the market, like gold, for example, Total Dog, even a lot of the Mag 7 stocks, and some of them have been cut in half, or those kind of names. So there's constant rotation taking place. And whether we look at this through the lens of cyclical and thematic trends, right, or we look at this through the lens of different asset classes in general, right, money is always rotating from one pocket of opportunity to the next best perceived opportunity. So we speak, and to me specifically, I speak to a lot of different ETF managers every single week, and I know that right now there's a large rotation taking place that a lot of people are simply not really willing to be open-minded to yet. So if you look at ETFs, and the reason we like ETFs so much for this kind of a strategy, it's that we have about 3,500 US listed ETFs. That's actually more than we have stocks, which is interesting. But that's because there's a lot of strategies, and so that's not a bad thing necessarily. So there's an ETF theme for almost anything imaginable, right? Different strategies, different sectors, groups, industries, levered, non-levered, inverse, you name it. And it's actually never been better, in my view, to be an investor and trader, because we can really isolate these different pockets of opportunity and not having to buy an individual stock. And this is not an anti-stock presentation here today or research call. It's just, you guys will see in a minute, we can isolate the opportunity better with an ETF than having to take all that idiosyncratic risk on an individual stock. So that's really the main the main point here. So we think there's profound opportunities for both trading and investing accounts, but we do think there's a new environment upon us. So it's full of rotation in and out of different sectors and industries. And over the past decade and a half or so, we've had less of that. We've had more or less a one-way train into one part of the market. Now, to address the question I sort of allured to that I would talk about, let's have a look at the reason why we want to use ETFs for momentum and sector and group rotation. First of all, it's a cleaner, direct exposure to themes, which means, again, without that idiosyncratic risk, which I'll show you in a minute, oftentimes we have good liquidity with options. So if we want to use leverage with options, we can do that too. And it's just an easier way to manage risk. So let me give you an example here, and then we'll go into the current market as well so you can see this even better. So here you have two lines. One of them is going up and one is going down. The blue line is going up and the red line is going down. What we're seeing here essentially is a theme, in this case an ETF, that was going up, right? But if I would have bet on a single stock, to bet on that theme, as opposed to buying the theme itself, in this case, I would have looked pretty crappy, right? Because it went straight down. So the theme itself was right. I was right about this type of industry group or sectors to go up, but it's just that the one stock, the one horse that I decided is going to do the best was actually not doing well at all. It actually fell apart. And so here's what happened. This was last year at some point, or even the year before, and this happens every day, by the way. It's just an example. It doesn't matter. I can show you, and I'll show you actually in a minute another example that's more current. But you can see what happened is, in this case, we were looking at artificial intelligence stocks through an ETF, and then that ETF went up. That's the blue line. But I chose a stock, a very prominent chip stock, SMCI, and it did the exact opposite. In fact, let's put some numbers around it. SMCI collapsed 71%, while the ETF I chose actually went up by 17 or whatever percent over that period of time. Right? So that's a huge difference in discrepancy. Let me just quickly stop right there. Has anyone ever experienced this before? Has anyone ever had this situation happen where you were correct about your thought process, right? But about the sector or group, but you chose a specific single stock, and you were not able to capitalize on that at all because the one stock that you chose ended up actually going straight down. Who's ever done that before? Yeah, it's a frustrating thing to do, but it happens, right? Give me a quick yes or type in me if you've done that before. I'm sure I'm not the only one that's done this before. There's got to be a lot of people who've done that before, right? And there's no shame in it. I'm just pointing out that it's something that happens, and it's something that is actually avoidable, right? It actually is avoidable. So let's take this a step further, and I'll give you another example. Gold, right? So gold has done very well over the past number of years, and some people like to trade gold stocks as opposed to gold itself. They think is a replacement. It's actually not, but just to give you an idea. So in this case, gold actually did okay. If I would have just bought gold, but if I said, I'm going to buy Newmont Mining, which is a gold mining stock, it actually went down, right? So instead of being up 27%, that stock actually went down 4.2%. So using ETFs for this is just a bit of a cleaner way of playing these kind of things. And this is not just me using this, having this empirical experience. We can go back and look at studies, both academic studies and again empirical experience for myself and other portfolio managers. Will all agree that the most critical part is actually asset allocation in returns of whether it's a trading account or a portfolio, meaning that picking the right stock is nice, but it's way more important to be in the right asset class, the right sector, the right group, or again, the right asset class, the right, whatever it is you're looking at thematically, not the individual stock. So basically, it comes down to this pyramid that I drew here. So stock picking, albeit nice and important, ultimately only explains about 20% of returns of whether it's a trading account or certainly for portfolios, whereas being in the right asset class, again, the right sector, the right group or whatever, explains 80%. So, and I found this is not just academically, I can tell you over the past 26 years doing this professionally now, a long time, I can tell you that is absolutely the best. These statistics are certainly true by my own account as well. So rather than trying to see, which AI stocks to be the next one, let's think about which theme in that AI thing or which industry or which ETF that represents a sector or whatever is going to be, an opportunity that I want to take advantage of. And so this is one of those slides where you definitely want to take a picture of, and I think this is important. So there's two things of risks when you look at a stock or even at a bond in that sense. One thing is systematic risk. So this is the non-diversifiable risk. So let's say if you're a stock person, this is the S&P 500. And then there's the unsystematic risk, right? Which is inherently individual to that individual stock or bond or credit that you're buying, right? So I'm a fixed income guy by nature, by training, and then moved into the global macro stuff over time. And when you look at this from a trading perspective, it's exactly the same way, right? So I could say, okay, I'm going to buy Microsoft, right? So if I buy Microsoft as a stock, I'm buying the general market risk where the S&P 500 might go down, in which case Microsoft might go down. But I'm also taking on individual risk on Microsoft itself, on management and what they do, what they don't do, right? And so if I'm betting on, let's say, a certain theme, AI theme XYZ, or whatever theme it is you're looking at, or sector or group or asset class, I can still make a bet on all that, but I can do it with much less systematic risk, meaning just focusing on the group of stocks rather than the individual name, right? Now, I'm not saying there's no reason to ever buy an individual stock. That's not what I'm saying. I'm saying it's a cleaner way of kind of running a portfolio. And so if we run this, let's say through our ETF ranker, here's kind of what this looks like. And again, if you guys have tickers that you want to go through, please let us know. I'll be more than happy to take you through any tickers you want. But like, for example, let's look at oil. Okay. All right. So oil is currently long-term still bullish, according to our model, but short-term, it's actually bearish, and it's been bearish for 36 days. Now, 36 days was somewhere around here, right? So just as oil started turning negative, our model also turned it bearish, right? And if I wanted to, let's say, take this on a chart, I can take an advanced chart, open up here, type in BNO, right? That's an oil ETF. And I could do my own technical analysis on this as well and draw lines and whatever if I wanted to do some additional work outside of what the algorithm just gave me. Someone has said before commodities. Can you look at commodities? So like one ETF you can look at, for example, is the commodity ETF COM, right? Now commodities, they're still long-term bullish and they're doing very well. The problem is that about a month ago or so, they turned bearish, right? And so you can see short terms, so 35 days ago, and we get this in real time, right? This happens, this shows up in real time down here when these things are changing. 35 days ago, it actually turned bearish, So that's nice to know, right? So that would be a situation where, okay, if I'm long oil, well, if the model turns it bearish, then maybe I should get out. So that's the beauty of using ETFs as opposed to individual stocks for this kind of strategy. I'm not saying never trade individual stock. That's not what I'm saying at all. But it makes the management of the portfolio a heck of a lot easier. And of course, one can use options, right? If one wants to use options for leverage, by all means, one can do that. And you know, we explain to people how to do that. What about something more high octane, like semiconductor stocks, right? And by the way, the holdings right now don't seem to be showing. It's probably just a refresh thing. But typically what you can see here every morning is the holdings of these individual ETFs. So when I click on and I type in any ETF, you will see down here the actual holdings as well, which is very, very important. It's not showing up right now. I promise you it'll show up again as soon as we're done here. I'm going to go fix that with my IT team. But you can see, for example, SOXX. So these are semiconductor stocks. Now you might ask yourself, has an ETF model, a strategy, did it capture this giant move that we've had over the past 2 months? In this case, the answer certainly is yes. So you can see long-term semiconductor stocks on our model have been bullish for 321 days. It's almost a year. So that's been a long-term bullish signal for a long time. So that signal came somewhere down here. Excuse me, somewhere like here. Yeah, over here. In the short term, it's been bullish for 86 days, which is also somewhere down here. So 86 days ago, the model gave us a new buy signal on a shorter term trade, right? So if I wanted to take this and we add things to our mock portfolio, which I can show you guys afterwards as well, and we send out the trade alerts based on our model. So right now, for example, if you're asking, hey, that's nice, but like, what does that actually give you targets? And the answer is yes. It gives us both profit targets and stop losses. As well. What about levered ETFs? Someone's asking. So you can, like, for example, you could use SOXL, which is a levered version of semiconductor stocks. That's quite something, but it's there, right? So you can see this thing too. It's been bullish for 93 days from a long-term perspective. Shorter term, 85 days was the buy signal. Again, somewhere down here, and it's gone from like 80 something bucks to 200 and whatever it is right now, $220. So you can see the next profit target is $321, and the trailing stop is $212 right now. Okay. What about gold? Did we look at gold before? I can't remember. All right. So gold, for example, you can see gold is actually in a longer-term neutral trend. Okay. But shorter term, 70 days ago, wouldn't it have been nice to actually be told, and again, these alerts happen in real time, that 70 days ago, gold actually turned bearish short term. That way, if I was long gold, I either could have sold it from a long-term perspective when at neutral, and then even maybe bought some puts or did an inverse ETF or something in the shorter term on gold based on that signal. So 70 days ago, what is that, 2.5 months or something like that? That's somewhere around here. It actually went short-term bearish and then went from whatever 400 and something now to $350 on the GLD ETF specifically. Okay. What about Bitcoin? Sure. So I don't know. Let's look at IBIT. That's a Bitcoin ETF. Yeah, that stuff's not looking too good right now. So again, it's about having a process. So Bitcoin has been bearish from a long-term perspective for 176 days. So that's half a year, roughly. That's a bit more. Short-term, it's about a month ago, and these are trading days, not calendar days, I believe. Yeah, these are trading days, not calendar days. So 41 days ago, so somewhere, like around here, Bitcoin actually turned bearish for the short term as well. So IBIT, which is an ETF that tracks Bitcoin, went short-term bearish. So that means I could have bought a put option, shorted it, bought an inverse ETF, anything like that. And you can see the next downside target is at $28.85, and the trailing stop is $37.73. If I want to take this onto a chart, like an advanced chart, we've we built in a fully functioning charting thing here for our clients because they wanted to do a bit more analysis, which of course is great. So I can go in here, I can draw some lines, right? Do my own analysis and say, hey, give me some perspective on IBIT. I can do all sorts of Fibonacci stuff and whatever, on this chart as well. So that's just the advanced chart feature in there as well. Okay, so now we've given you a bit of an idea. And by the way, there's a whole bunch. There's actually a couple of ideas I'd like to show you that have just triggered over the past couple of days. We break down the market into short-term and longer-term, and every single sector ETF, a lot of commodity ETFs, industry group ETFs, themes and styles are being ranked here, so we know both what the long-term and the short-term signal is, and also when they're brand new ones. So, for example, recent short-term signals, right? Buy signals or sell signals. Like one of them that just came across here, I just wrote it down, that I was looking at ARKK. Oh, there you go, ARKK, right? So this one, if I look at ARKK, for example, so I'm going to go up here, type in ARKK. This just came on the past couple of days. And you can see it's actually, I think, up again today. So 6 days ago, this turns into a new bullish trade. But long-term, it's still neutral, right? So it's a trade, not an investment yet, ARKK. The ETF, and the next profit target is $83 or so. I think it's up again today already, almost at that point. And the trailing stop is $78 and change, right? So that's how that works. And again, I'm happy to elaborate. And again, you guys can have access to that tool as well. We can make that available for people who are interested. So we've gone through a bit of a market update, S&P 500, some of the opportunities and risks. We've talked about the key roles of ETFs and where we rank them all with our algorithm. I'd like to go through a couple of setups that I think are really interesting right now, and that we actually just recently added and already took some profits in our mock portfolio where we rotate through the market this week. So there are some specific opportunities that we believe are through a multi-quarter perspective and that we continue to rotate in and out of in energy that are extremely, extremely bullish longer term. Material stocks, hard assets like copper and uranium, these are all available through ETFs. So we no longer have to open up, a futures account that we used to have to do. And then also the AI application layer. Now, the AI application layer is just one part of the market, but let me just, before I go into one major idea, let me just give you a little bit of perspective on sort of the energy sector and why we think that's actually about an 80% return opportunity over, a few years or so at the most. So the energy sector itself is one of the most under-owned sectors in most portfolios, and it's severely invested in the industry itself of energy. The risks are actually that we see serious price shocks or spikes to the upside, not to the downside. And of course, that translates into massive opportunities that we don't want to discount. In fact, if you look at this quilt chart, maybe you guys have seen this before. This is the breakdown of the S&P 500 through the lens of different sectors. And you can see the technology sector, which is actually, if you properly add it up, closer to almost 50% of the S&P 500, whereas the energy sector is only like 3% of the S&P, right? And historically, if you break it down, you can see the tech sector is not 50%, but closer to maybe 25% of the S&P or 20. And the energy sector, which is now 3 and change, maybe 4 or whatever, is typically about double that, right? And the energy sectors and those things look really, really good as well. But I wanted to spend a little bit of time on one specific opportunity that we actually just took some profits on this because it was so juicy. We wanted to take some profits off the table. But the next AI super cycle. So this is another one of those few slides you probably want to take a picture of and kind of take it back and think it through yourself a little bit. So this is the next AI super cycle. And we think the next AI super cycle is not chips, but it's the application layer in a very specific industry. And here we can really capitalize on the computational biology revolution with systematic ETF allocations, right? So we don't have to pick an individual stock. and take a lot of risks. And there's a lot of risks in these things, in individual stocks. And so specifically, if you look at, for example, biotech, which if you look at the past couple of weeks, these names had a big run. We already took it off the table again, but we think there's a massive opportunity, and I can show you guys. We can run it through our scanner as well, so you can see this yourself. But this is really the opportunity to unlock a multi-billion-dollar shift as artificial intelligence really revolutionizes clinical timelines. And I went to a healthcare conference. When was that? Last week, I think Thursday. And it was just incredible what's happening in that industry right now, thanks to AI. And so I thought about this and went a bit deeper, had some analyst calls since then. And we think like the global AI biotech, market is actually projected to skyrocket from sort of an 8 billion-ish in 2026 to about 154 billion in 8 years from now. So that's a CAGR of compounded annual growth rate of like 43.5%. And there's just a massive secular transition of research budgets shifting away from sort of the traditional static labs and towards, as I wrote here, enterprise scale cloud computing and genomic machine learning platforms. And this is really where AI starts to shine, because we haven't really seen a whole lot of situations yet where companies are saying, hey, AI has helped us become a crazy profitable company or revolutionize an entire industry. We're seeing it a little bit, but it hasn't hit the scale. So far, the AI game has been all about, let's sell a whole bunch of chips and get a chips squeeze. So now we have what's called AI inflation. You saw last week Apple have to raise its prices on MacBooks, and Microsoft has to raise its prices on Xboxes, all because we can't get enough chips. But we think the next opportunity is actually really going to be much more in the application layer, and one of them that's really juicy to us right now is genomics. So here's the thing, though. When you look at an opportunity like this, and you try to go in there and you say, okay, I like the idea, Serge, but I'm going to go find that one stock that's going to absolutely hit a home run. Statistically speaking, that is an extremely low probability game. I'm not saying don't go out there and find one stock and put a little bit of game money after it, by all means, right? However, from a probability perspective, the odds of any given investor at home or professional to pick that one stock that's going to hit it huge over time is so small that it's just really not worth doing. Ask anyone who bought, stocks back in the .com bubble. No one knew that Amazon was going to be the next Amazon, right? It happens every single time, and we don't know. And vice versa. There were companies out there that people thought were going to be the next thing. Like the Time Warner, merger was the peak of the .com bubble. Time Warner AOL thing. AOL bought Time Warner at the time, and people thought that's going to be the greatest thing to sliced bread, and then it all fell apart and just totally unraveled. And so we just to kind of show you the dispersion that we continue to see. So for example, if you look at the biotechnology ETF, IBB, which I'm going to show you guys on the scanner, and again, you guys can have access to that scanner for those of you that want to afterwards, because it gives you profit targets and entry points and trailing stops and alerts, when there's new buy and sell signals on ETFs. But you look at IBB. This is the past, what is that, a couple of months? Yeah, April, May, June, 3 months. So it's 90 days. So over the past 90 days, gold is down 9%, right? And IBB, which is a biotechnology stocks ETF, is up 19%. Give me a quick ME, if you can start to see that it would be beneficial to maybe have a process that allows me to rotate out of something that's about to go down or is in a downtrend and rotate into something that has much more, better odds of going up over a certain period of time. This guy, I can't be the only one here that thinks that's an interesting idea to do. So the performance dispersion of gold versus biotech stocks over the past 90 days is 28%, right? So biotech up 19%, gold down 9%. And that happens all the time. I'm just comparing two assets here. We could compare two totally different assets and get very similar type of dispersions. And so here's the thing, though, and this is really where I want to spend a bit of time on. And again, I'd love to get some questions if you guys have any. And again, if you have questions, if you have a phone with you, take some pictures on this. So the idiosyncratic risk, failure risk, is really, really big in really any given industry group. But in the case of an AI application layer, that's even more so. So if you think about this biotech thing I'm talking about right now, right, which it's been a big week, by the way, for that. So the idiosyncratic failure risk, so is massive. So basically, individual preclinical biotech stocks are sort of exposed to essentially binary failure events, and this is really just how it is. Yet people constantly try to think this is the next big thing. So you have one bad FDA trial, and all of a sudden, your funding can be wiped out. 80% of an individual's equity capital can be wiped out, as I wrote here. And so these early stage companies in this specific instance, and this is going to apply to a lot of the application layer in general, it's just extremely, extremely high risk to make a bet on one stock. When in reality, what I could do is use an ETF that encompasses that theme, right? Where I'm essentially inherently diversifying that risk with an ETF. So I'm eliminating, for the most part, the idiosyncratic risk, the single company operational vulnerabilities, be that because the company does something stupid, be that because of accounting shenanigans, be that because the CEO does something stupid and sends naked pictures or something. I'm kidding. I mean, actually, it happens, right? But who knows? The point is there's a lot of stupid things that can happen, and we can actually sidestep that to a good degree by using ETFs, right? And these ETFs have a lot of liquidity for the most part. We can even use options on them, and it's just a much more sort of lower octane way of looking at things, right? So that's the advantage that we like to point out. Now, we're going to get through a whole bunch of more individual ETFs and things that you guys want to look at in just a minute, but I want to just quickly point out a couple more things that are making this environment right now quite dynamic. So this is just an inflation chart. And if you look at inflation, the way it's tracking right now versus the 1970s, we're about here right now. We've had an inflation uptick. We're back up to 4% on PCI the other day, last week. And so if the past has any resemblance of what the future is going to be like, we're likely to have a bit higher inflation going forward. And that, by the way, and this is just a side point, has a profound consequence of which parts of the market are going to do well and which are not going to do not so well, right? So inflation, the rate of change and growth are two critical inputs in how markets behave up or down. And different parts of the market can do a lot better than others. So we think based on that, things like hard assets and materials are going to do very well going forward. Be that copper, we can add copper into an ETF. And so that's another big opportunity out there. So again, there's almost unlimited opportunities of how to rotate through the market. One thing that I think a lot of people find helpful, and again, we'd be more than happy to give you guys access to this sector rotation ETF guide, which ETF to use for which part of the market, be that a specific sector, an industry group, or whatever you're looking at, right? So we've got a 19-page ETF rotation guide, which breaks down the market and different ETFs. So if you say, okay, I'm interested in that sector or this industry group, you can go and open up this ETF. It'll tell you which ETFs correspond to the type of sector group, whatever that you are interested in at any given point. And here's something really, really big. I want you guys to really think about this as well. So the large institutional algorithms, the trading machines, they are using ETFs for their momentum rotation strategies. So when you see, for example, let's just go back to our ETF scanner. So let's say you wanted to look at IBB, right? We talked about this. So IBB, 20 days ago, which we looked at before, we just talked about this before, right? IBB is an ETF that tracks US large cap biotech stocks. So IBB 20 days ago, factually, I'm not making this up, so somewhere down here, turned into a bullish trend, into a short-term bullish move. So around $172.50, it's now trading at almost 188 or whatever it is right now. So the upside target is $196 with a trailing stop at 184. And again, if I wanted to put this onto a more advanced chart, I could do that and do my own analysis as well. And you could see how beautiful that breakout actually was. In this case, as IBB goes higher. But institutional investors are using this. Are using this as well, right? So institutional investors with the big pockets are using a lot of ETFs for their momentum allocation strategy. And that's where we can get seriously fast moves happening very quick. Like, for example, we just took profits in ARKG and had a nice gain just over, I don't know, like a week or so. Oh, ARKG, which is an interesting name for the biotech phase as well. So you can see 41 days ago, so somewhere around here, this turned into a bullish trend around 30, bullish short-term move around $31. It's now closer to, what is that, 42. That's a big move, right? And so these are the opportunities that we can capture through the lens of a sector and group rotation strategy. And I gave you tons of examples of this in the past, but the most important thing, I think, this is a very repeatable process. And by the way, you know what else are ETFs? What about the S&P 500, the SPY? What about the QQQ? What about the IWM? These are actually all ETFs. And so again, last year, for example, just rotating through the markets, if we added up the gains of the individual trades we had on this strategy, we were able to rack up 230% of gains on the individual trades. And so far this year, we're up 73%, I think we said before, right? You could see that by looking at the dot right there, that corresponds to 73%. The S&P is up, doing pretty well. It's what is it, up 10% year to date, something like that, a bit less, right? And so that's where ETF Silo Pro comes into factor. So this is our technology, our trades, our mock portfolio. It's education plus an experience as well. This gentleman here wrote to us about his experience with it. You can see his account went from, like 822,000 to whatever his portfolio value was, 926,000. That's not. I'm not saying this is normal or everyone does it. Just someone sent this to us, and so we actually track every single trade that we do in the mock portfolio. We send it out with the specific reason why, and when we close out the position as well. So we track this as an actual mock portfolio. Most of our clients enjoy just to literally copy it. And I'll show you guys what it looks like in the members area as well. So when we send out a trade alert, we say, okay, today we're adding ETF XYZ to the mock portfolio. Here's the reason why, with a chart. And some people like to use options in that as well. So we talk about options in the member sessions as well, which the next member session is coming up in a few days, actually. And on our members area, which I can show you as well, we actually have the entire mock portfolio on display so that our clients can go in there and see the exact mock portfolio, all the positions, all the ETFs, how we're currently positioned. And of course, everything is timestamped. Even the past trades that we've done, they're all there on the members page. So it's ETF Silo Pro. Again, we did 230% last year. So far this year, about 73%. If you can see the value in not only, and by the way, the Kickstarter class is not June 1st. It's next week. It's next Monday, actually. I think it's on July. Let me quickly check here. I should have updated that. It's on July the 6th. We're going to update that here in a second. At 11 o'clock, you guys will get an email on this. So what you're going to get with ETF Silo Pro for a full year's access is unlimited access to the entire mock portfolio, the trade alerts, the ETF scanner that gives us the exact entries, the profit targets, both the short-term and long-term on all the ETFs. So if you're an ETF person or you just have a portfolio, this is for you. You can either do 3 months for $497, or you can save 50% and take advantage of that discount and get full access for 12 months for only $997. So the full price, list price on the website is $4,477. So you're getting a hell of a deal here today on this early July 2026 summer offer here. Again, the next member session starts on July 6th. It's not June 1st. I will adapt that a little bit later. We also do monthly member sessions, so everyone knows exactly how the mock portfolio is structured, and how you can position yourself based on what we are doing. Also, a lot of people always ask, what's the position size? We give you very clear guidance. We tell you how volatile any given ETF is. I'll show you this in a minute, so that you can then position size on that as well. Let's talk about some bonuses. Again, it's actually July. Let me quickly adapt. This is silly. So it's July 6th is actually when this is going to take place. July 6th. July 6th. And again, you guys will receive an email. It's July 6th. July 6th, 2026 is our next member session. 11 o'clock Eastern, 8 o'clock Pacific time. And we're going to look forward to seeing you guys in that session. Come armed with your portfolio, with your questions as well. The Power Ranker, this is the ETF Salo Pro Power Ranker. We'll go through it a bit more here in a few minutes. But again, it ranks every single ETF, long-term, short-term ideas, profit targets, and it spits out new buy and sell signals in ETFs every single day. So you go ahead and lock in your price right now before the slots are taken here today. We also have fresh momentum ideas every single week, as I said, so that's another bonus. And of course, we do our member sessions in our monthly members call as well. Additionally, if you are a Bitcoin person, we also offer a Bitcoin options video that you guys can watch if you are interested in that. In fact, a lot of people like to use options with ETFs. Who likes to use options with ETFs? Type in me, if you like to use options with ETFs. All right, if that's you, you're going to be in great shape as well, because we're going to talk about how to use options with ETFs, which can certainly, sort of boost the leverage a bit as well. The sector and group rotation ETF guide, we talked about that earlier. If you would like to have access to that, you can, again, sign up here right now, and then you will have access in the members area, which I'll show you in a minute, to the sector and group rotation ETF guide. So the choice is yours. You can either do 3 months for $497, or you can just do a full year and save 50% for only $997 right now. So let me go through some of the questions, and let me go through some more things. And there's a couple of actual ETFs that I want to show you guys as well that just fired off on the in our ETF scanner. So first of all, let me quickly show you the members area and what that looks like. So when you enter the website, you're immediately greeted with the scanner, which again ranks every single ETF, bullish, bearish, short-term, long-term, tells you exactly when something is new, short-term bullish or short-term bearish, same thing for long-term. If you want to know about which sectors are bullish or bearish, according to our algorithm, both long-term and short-term, it gives you all of that as well. I want to show you guys a couple of ideas, and I'm going to quickly, by the way, the link, I should have told you the link. So the link to grab this right now, we're taking 25 people today at this price here during the webinar. Afterwards, the price goes back up. So if you want to join us for that discount, make sure you do that here before long. It's steadytradersecrets.com/silo is where you can go grab that. And again, it's July 6th is the next session. So July 6th, 11 a.m. Eastern, 8 a.m. Pacific. Okay. So let's look at a couple of opportunities that are just showing up here right now. So one opportunity, and I alluded to it before, you can see if I just go to the short-term bias trades, right? So recent short-term ideas, you will see that ARKK was added over the past few days to short-term bullish. Another one that I've been watching is an ETF called iPay. It's I think on a couple pages down that I just noticed the other day. So let's type in iPay. And this is one of those ETFs that focuses on digital payments, right? So if you're bullish on digital payments, yes, there's an ETF for that. I'm going to make this a bit larger so you guys can see. So it just recently, 6 days ago, turned into a short-term bullish trade. That's just a trade. So 1, 2, 3, 4, 5, 6. So somewhere around $43.50. It's now, as you can see here, around 46. So that's a nice move. That's almost 10% or 8%, whatever it is. Again, I could use options on that if this ETF has options. If I want to be a bit more specific, you can see the next profit target is at $47.65. And the trailing stop is at 44.55. Now, if I want to look at this on an advanced chart and go and type in iPay, you can see and do your own charting pattern. Maybe you say, okay, this looks like a bullish thing, right? We got a higher lows and whatever and whatnot. You can see how this is turning into a bullish formation if you want to use your own analysis as well. That's a full-on charting platform that we have included in your access to ETF Silo Pro. So if you're looking, whether you're looking for trades, whether you are looking for and a trend following allocation model, this is all here included. So the ETF rotation guide is included for those people who are ETF Silo Pro members. Because one thing we want to do is we want to make sure that if you have your own idea, and also I think it's important that everyone kind of knows, if you're applying a sector and group rotation strategy, I think it's important that everyone knows kind of which ETFs to go to for which idea, right? Which theme, which sector. So as soon as you come on board, it'll be in the members area. So in fact, it's under the resources page. As soon as you sign up, under the resources page, you can see it right there, sector rotation ETF. Again, you have access to the monthly trading recordings, the scanner, which of course is sort of the fillet, if you want, right? And of course, maybe the even bigger fillet for many people is the actual current ETF holdings, right? So this is the actual mock portfolio, right? Here you can also look at the actual past trades, all the closed trades, last year, this year, whatever. Go back and see. So again, you can see I'm not pulling these numbers out of thin air. These is right there. This is literally it, 73.3%. And you can look at the current openings as well. So it's all there, fully transparent, and especially when you have an onboarding phone call with one of our team members, they can walk you through this as well. Can you show SOXL again? Sure. So SOXL is a levered ETF on semiconductor stocks. By the way, this thing had a lot of inflows. It's funny you guys are asking about this. Let me just make this a bit larger so you can see this. SOXL. So just imagine SOXL. This became a buy 85 days ago. You guys can see the, if you go back 85 days, it'd be somewhere here, somewhere around $52. This ETF is now $241. The next profit target in the upside is actually 321 on this. Okay. Chris is asking, will a recording of this be sent later? I'm at work and we're short staff this week. Probably, Joel, maybe, or whoever's staffing, maybe you can figure out how to get in touch with him and see if there's a recording that we possibly might be able to send to the gentleman who is at work today. Yeah, that makes sense. Okay, now, question I saw before. what about options? And can you do this if you're just getting started? Yes. So it's a mock portfolio and a very, very straightforward scanner, right? So for example, if what most people like to do is most people like to literally just copy and paste it. I have clients from all walks of life that are using this literally as a copy paste thing. But remember, we can't give you legally investment advice, so this is education, right? But they literally go in and they take when we send out a new trade idea to the mock portfolio and they add it. What's really critical here? What's really critical here is that the portfolio itself, we have to call it a mock portfolio. That mock portfolio is actually a portfolio, meaning that the positions in it are there for a reason in coexistence, right? So let's go back to a previous slide that I had up here so you guys can see this. So this is, for example, what the mock portfolio looks like, right? So I don't want to show you the current one because it's unfair to people who are not members, who are members. But I showed you the trades we just closed and everything. This is just a screenshot from late last year, right? And this is exactly, it looks exactly the same, format right now. So when you go into the members area, as soon as you're joining, all of you guys that are joining, again, we're taking 20 people here today. So when you go in there, the ETFs in the mock portfolio, they're not random. They're in coexistence for a reason. So this is not a random trade alert thing, right? You can certainly do your own trades with the scanner and use options, and we'll teach you all that as well in the member sessions. But the mock portfolio itself has positions that have reasons to coexist together, right? So I'm not going to add in there, a technology ETF and then another technology ETF because it just has a couple stocks different. Like that makes no sense, right? So there's always going to be sort of a trade-off a little bit, and we hedge it a little bit if you want to call it that way, because we're rotating through the market, right? Does that make sense, everybody? By the way, who's learned something here today so far? We've gone about 50 minutes here so far, so I want to make sure you guys are learning this. Again, we're taking 20 people here today, and so one of the first things that you'll learn when you set up an onboarding phone call. So most people will literally go in and just basically use this as a mock portfolio, meaning they will go in and the trade alerts, I'll talk about how often we do those as well, and just literally copy the portfolio. That's typically what most people do. Whether that's right for you or not, again, I can't give you advice, but that's what most of our clients tend to do. Now, what about options and what about trades? So we typically I typically make at least usually about 2 changes a week to the mock portfolio. And the trade alerts, if you want to call it that. So both when we enter something or we exit something. So I'll show you this. So for example, I'm going to show you the closed positions that we just closed. You can see what this looks like. So let me go into the closed trades here, closed trades. Okay. So you can see, for example, the most recent, I just told you we just closed ARKG. So you can see we entered it on 622, and you guys can go check your charts and see on this. So 622, which is the 22nd of June, we added it in real time, goes out with an email, and we closed it on 629, which is a couple days ago, right? For a 15% gain. If one would have used options on that, which we will teach you in the member sessions, that gain would not have been 15%, but maybe closer to 3-4x that if one would have used options, right? Whether you use options or not is your own choice, right? That's an individual choice, but that's factually what would have happened there. Does that make sense? By the way, if you have any questions, you can call 561-769-3025 to get on the phone with someone who will be gladly talking to you through any questions or concerns you have, or even order through the phone if you want to. You can also use PayPal, by the way. So A lot of people like to use PayPal just because they have PayPal accounts, but PayPal also allows you to finance stuff. So in this case, PayPal allows you to finance this. It's not us financing it. PayPal does it. And I heard they even do it like at like no interest for a while. So I don't know. It's interesting. Again, I'm not here to pitch anything from PayPal, but I'm just saying like we offer that through the PayPal, I guess, partnership, if you will, integration here that we have. What time of day do the trades go out, and what about options? Okay, so I typically send out these updates to the mock portfolio, call it trade alerts, adding something, removing an ETF. It typically goes out in the morning around, I'm going to say between 9:30 and 10 o'clock Eastern time. So in the morning, Eastern. That's obviously way earlier on the West Coast and so on and so forth. You can do the math in terms of where you live. In some cases, if something really has to be closed, whether we reached a major profit target or we stopped ourselves out, there might be an email going out throughout the day. But for the most part, I'm going to say 80 to 90% of the time, it'll be an email that goes out in the morning at some point so that there's a really steady rhythm. What about options? So for options, not all ETFs have options, but plenty of them have good liquidity option liquidity. And we will teach you exactly how to use this with options. If anyone in here wants to use this with options, let me know, and I'm happy to give you a bit more details on that. But sometimes you don't need options. Like SOXL is already a 3 times levered ETF, so using options on that, might be a bit much. Yeah, that's that's up to everyone on their own. But the beautiful thing about levered ETFs or even inverse ETFs, like the other day we actually had an inverse ETF on here, is that we can also play the market in both sides, in both directions. So whether it's a bullish bet or a bearish bet, we can do that. I try not to short ETFs. We will talk about some of these things. If you wanted to be bearish on something, we will prefer from a mock portfolio perspective to just use an option, to use an inverse ETF. Obviously you can use options as well if you want to do something on your own. But the ideas in the scanner are there every single day. There's brand new ideas, recent short-term ideas, buys, sells, long-term ones, updates as well. So those are dynamically updated every single day inside of the scanner. We actually call this the scanner is called, it's got a name. I just call it the scanner, but we actually call it the ETF Ranker Power Pick Scanner. It's a mouthful, but that's what we call it. No. So that alone should be something very, very valuable for those of you guys that like to use ETFs. Again, if you want to use options, like Michelle said, she use options. Obviously, we talk about that in the member sessions, and we give you a really good idea on how to use that. How to use options in this with ETFs in general, not just with the mock portfolio, but in general. Okay. All right. What else? Can you use? What about the sector? Oh yeah. So I think the question is, what about the sector? So if you want to know which sectors are bullish or bearish, short term or long term, let's say you're running like industrial stocks. Okay. So you click on sectors, the XLI ETF, for example, it's currently bullish in both time frames, short and long term. But let's look at a bit more detail. Let's look at the XLI ETF and make this full page. So you can see 37 days ago, let's call that 40 days ago, which would have been somewhere around here, around $173. The XLI, the industrial stocks ETF, went bullish short term. It's now somewhere in the low 180s, right? So, and the next profit target, by the way, is 189.15, and the trailing stop is 181.31. You can use the advanced chart and do your own analysis as well if you want to, and use whatever technical analysis on there that we have. And long term, the industrial stocks went bullish 93 days ago. That's like 3 months ago, right? So somewhere back here or something, they went bullish. So, and every single sector is broken down. A lot of industry ETFs, themes and thematics. Like for example, BITO. Let's talk about BITO for a minute. Like this is an ETF that's blown up a lot of people. Where's BITO? I just had it there a second. So let's type in BITO. So this is one of those, Bitcoin strategy ETFs. Well, it's been bearish for 41 days, short term. Definitely something to make money on it. But it's been bearish long term for 226 days. So people who are still holding on to this, they probably need an algorithm that's a bit better than a talking head on TV, to tell them whether something is long term or short term bullish or bearish. Right? A lot of people are sitting on horrible losses, by the way, on some of this Bitcoin stuff like ETFs and different things. But you will go back and you can see exactly. And by the way, when the next buying opportunity comes, be that an IBIT or BITO or Bitcoin or whatever, like it'll give us those things, those details. It'll first start with a short-term bullish trade, and ultimately maybe goes long-term bullish. So yeah, that's what happens. I don't know how many slots we're at right now, but I'm going to have to assume they're probably going to be taken up pretty soon. Yeah, if you guys have any questions, you can dial our team. Again, the phone number there is 561-769-3025. And the next member session is July 6th, is what we said, right? July 6th at 11 o'clock Eastern. And these sessions are cool because people like to come and join and ask questions. And of course, we teach them about different things, options, and how to use the mock portfolio. And I want to just end on one note. First of all, yes, you can either pay $497 for 3 months, or you can basically save 50% by going for 12 months at only $997. So those are your two choices. You get unlimited access to the trade alerts, i.e. the mock portfolio, and the ETF. Ranker, and of course the bonuses like the PDF, which you can download off of the website as well. So that's all included. So I end with one thought, right? So again, a lot of people are sitting in a lot of gains right now on different things like semiconductor stocks and Nvidias and all those things. And so a sector and group rotation strategy can go a very long way in helping us be a bit more risk adjusted and hold on to the gains that we have in some of these stocks that everyone owns and they don't want to pay taxes on it, they don't want to sell them, but also be a bit more tactical about things, right? And it's a really good median, sort of a median way of doing things. So that's really what we like about it. Our clients love this. I will tell you, this is my favorite strategy because it is allowing us to take advantage of major thematic moves, be that a specific AI theme, be that a specific commodity theme, be that a specific sector somewhere else, whatever, right? And you guys will love it as well as this going forward as well. Okay, cool. All right, folks. Well, again, all of you guys that want access to the things you mentioned, just let us know. Go grab the link, and we will see you guys on the inside. I don't know how many slots are left. I'm assuming probably typically about 4 or 5 slots. And again, steadytradersecrets.com/silo, 561-769-3025. Thanks for being here, and we'll see you guys on the inside.